Ajay Bodke, the CEO and Chief Portfolio Manager at PMS, that's Prabhudas Lilladher, now joining us. Hi Ajay, always a pleasure talking to you. So let's get straight down to it. Look at the way our markets have done this year, despite the fact that, you've seen the FIIs pull out. There has been a very strong recovery. Next year, a lot of uncertainty. I think the three-state assembly election results have really spooked the markets. The RBI governor fiasco has been dealt with. Before we get into specifics, tell me, what's your overall strategy? Is equity still the best asset class or a great asset class? And what are your expectations going into the new year?
Good afternoon, Nayantara. It's always a pleasure to be on your show. I think we are constructive on the Indian equities with a medium-term perspective. I think most of the macro headwinds that had ended up challenging the Indian equities over the last 3 months. I think one has seen a complete turnaround of that because of the sharp plunge in the global crude prices by around 30 to 35%, and that has eased pressure on both the trade deficit, current account deficit. Fears of imported inflation have receded, and the growth inflation dynamics has got a tremendous leg up because of this tremendous turnaround in the macros because of the sharp plunge in global crude oil prices. Also, I think the inflationary prints over the last few months have been quite benign, and with the RBI also expecting the same trend to continue for the next 6 to 9 months. We believe that the room for at least 2 rate cuts, one in February and a subsequent meeting again 2 months later, has opened up. This is especially so because the Fed clearly has indicated that they are somewhere close to the neutral rate, and hence concerns that many emerging market central banks faced about reversal of carry trades and pressure on the currencies has also receded. Also, I think I believe that on the political front, whichever combination comes to power in May 16, one clearly has seen that in India there is a bipartisan consensus for most of the structural reforms that have happened. So some of the signature structural reforms that the Modi government implemented, be it the direct benefit transfer and Aadhaar, or RERA, or the insolvency and bankruptcy code, or for that matter even GST. If you look at the genesis of these reforms, it lies during the 10 years of UPA rule, and the implementation was carried out by the Modi government for these reforms. So I don't think that even if there's a change of guard,
fair enough,
I think markets should really be concerned about any changes. So I think from overall perspective, I believe that the market is poised for a strong run 18 to 24 months from now.
So you're expecting a strong run, 18 to 24 months. So tell me something, Ajay. When you expect this strong run, what are you betting on? What are the sectors that you like a lot on? For example, I know you guys don't like IT and pharma, or at least neutral to it, but there are you like oil and gas, for example. How are you approaching that?
Yeah. So so insofar as portfolio construct is concerned, what we are going with is an overweight on interest rate sensitive sectors. As I mentioned, we are expecting a change of stance of RBI to neutral in the next meeting, and also lowering of rates by at least 25 basis points immediately and 25 basis points in the subsequent meeting. So sectors such as the banking and financial services sector, automobiles, consumer durables, I think we are advocating an overweight stance out there. We are expecting the rupee to strengthen going forward, and hence and plus the fact that the valuations in some of the leading IT names are quite reasonable, and there is not much scope for re-rating. We think that on the IT pack we are neutral. In case of pharmaceuticals, I think there are specific issues dogging some of the leading companies, and that's why on pharma also our stance is a bit cautious. Insofar as oil and gas is concerned, I think we are constructive. Oil prices have come off quite sharply. OMCs, as well as companies like Reliance and some of the gas companies like IGL, as also a company in a leader in the lubricant space, Castrol, we are quite positive.
Ajay, hi, it's Karunya as well joining into the conversation. I was just reading about a couple of names that you have picked out. Maruti and M&M for one are the ones which are featuring in your list. Do you believe that all the negatives are priced in and going into the financial year we're likely to see some pickup in demand?
Yeah. So I think the headwinds that these two names and as also many other auto names are facing is the fact that last 2 or 3 years the demand has been quite robust, and hence the base effect sort of from now till March, I think there is a wall of worry that these companies have to climb sort of to overcome the base effect. But I believe that when we are moving into a neutral kind of monetary policy stance, and the new RBI governor is committed in terms of ensuring that the liquidity needs of some of the stress sectors like NBFC, MSMEs are adequately addressed. Also, I think one has usually seen that in the run-up to any general election, the demand for passenger vehicles, SUVs, usually sort of moves up quite sharply for electioneering, etc. And the valuations for these companies also are now far more reasonable. From 9,500 levels, one clearly has seen a sort of Maruti coming down to 6,500 and now bouncing back. So there is still some scope sort of for a re-rating to continue. Insofar as M&M is concerned, I think in addition to the tractor business is chugging along well, the launches over the next 15 months are what excites us on the passenger vehicle side. So I think we believe that there is a good re-rating potential in both these names, and investors should look at them with a 18 to 24 month perspective.
Right. Ajay, on that note, thank you so much for taking time out to chat with us in detail about how you're reading into the macros and what you expect, which are the pockets you expect to do well going ahead.